And we're live with the virtual real estate investing podcast. Frank, how you doing today, man?
I'm super pumped. We got the Wall Street Junkie. Oh, that's his IG handle anyway.
Yeah.
On the podcast today. I'm actually excited because we talk real estate almost every episode. We talk single family, and today we're going to be able to talk about like the fun stuff, stocks, cryptos, degenerate,
degenerate stuff.
But I'm just based off your page, so I'm really pumped for today's episode. It should be fun.
Sure.
And we're happy to have you, Josh. Welcome.
Appreciate it, Frank and John. Thanks for having me on.
Yeah, so let's jump right into it. Tell me about your business today. Tell me about your hobbies today. Tell me about your goals today. Who is Mr. Josh?
You got it. So much like you guys, I had a little bit of a background in the military. So I went to Texas A&M. I was in the Corps there, did that whole gamut. And then
Go Aggies.
Go Aggies, whoop. And then after that, I did 6 years in the Army National Guard, and I just finished that up. And while I was there, I was just working a boring USAA job. I was trading mortgage-backed securities for them. So kind of an interesting gig. But about 8 months ago, I hung up the hat and said, I'm going to do my own thing. And that started kind of segueing into real estate. So I've always been a real estate investor. And so now I took over my parents' brokerage. So the sales piece thing. And during that time, I also kind of developed my alter ego, Wall Street Junkie, Chad, you name it, on Instagram and TikTok. And that's where I'm kind of into the personal finance and educating people about the benefits of long-term investing, not just like what Frank was talking about, degenerate gambling. Not really big into that, even though my age might tell people that I love AMC. I don't fucking invest in that. Absolutely not. So that's a little bit about me, man. And that's kind of what I've got going on right now.
Okay.
Awesome.
So let's jump right into the investing piece. Since you're diversified, because I see your page, you talk about stocks, indexes, value investing, real estate, the whole gamut. Let's say I'm 30 years old. I got 100 grand cash, right? How am I splitting up my portfolio, or how is Josh splitting up that portfolio?
I got to ask, do you have retirement accounts set up? Do you have
Let's assume you do. I don't want to give you the easy way out. No, we're not
Okay.
doing retirement. So you got 100 grand, you're liquid.
100%. So I think for me, you have to establish your financial goals. I think age-based allocation is garbage, first of all. You hear, and especially in the military, you probably know this, they put you into these target date funds, right? Where it kind of assesses your risk solely based on age. And in a world where interest rates are so freaking low, that allocation of fixed income is going to kill and drag your return on your portfolio. So first of all, I want people to know, just because your age is just because an age it's not a proxy for risk. I'll say that. It really matters on your goals. But nonetheless, a 30-year-old, I think you guys would agree. I am so bullish on single family right now, or real estate in general. I would say your first goal would be to start preparing for that down payment on real estate. And it gets a little tricky. If you can do it within the next year or two, I would say you do your FHA or your first time home buyer loan. Try and get as little cash as possible down, only because right now in this environment of interest rates, it's negative real interest rates, right? Because it's CPI right now is like 4% interest rates.
Before you go forward, CPI, what are you getting at there? I think just in
Inflation.
case someone else doesn't know. Yeah.
Shoot, inflation, right? Everyone's talking about inflation. Oh my God, the sky is falling. I could get into that later, but 4% inflation rate is kind of what people are thinking right now, which is much higher than it's been for a very long time. The thing about that, though, you have to understand is you as a borrower, inflation's a good thing, right? As inflation climbs, that means the money you owe on your debt is worth less and less. So as a borrower in these rates, and given where inflation's at, it makes sense to borrow, but still save your cash. But as far as an allocations perspective, I think your first goal is to get that home in whatever facet you can, 3%. But long-term allocation, my portfolio, how it's set up at 26, I have about 30% real estate, which I really believe in, and then about 65% equities and 5% cash. I don't believe in fixed income right now. I think there's other ways to get yield income on your portfolio. So that's kind of a little bit of a overview, I guess.
Yeah. So let's 30% real estate, 60% equities, but let's go one step further. That can mean a lot of different things.
Yes.
So what does it mean for Josh?
So for me, 30% real estate, I'm almost entirely invested in single family real estate. I've talked about this on my podcast a lot. I think there's a lot of good opportunities, multifamily, but right now, given where institutional money is flowing, I think single family is absolutely going to crush any other sort of real estate asset class. There's a lot of things going there. I think the builders, I was reading a lot of reports. I think building is down 80%, I believe, and builders are just slow to it. They got burned in 08. And so there's just pent up demand. There's housing shortage that's not going to get cleaned up anytime soon. So single family, I think absolutely should be on your radar right now.
And then I promise I won't keep digging down forever.
Yeah. Oh no, absolutely.
So single family, one of the discussions we talked about in our newsletter this week is historically Frank and I love the 1% rental, right? The $130,000 rental that, rents for $1,300 a month, almost impossible to lose money, right? More and more though, we're looking at the $250,000 rental that maybe, the rent on that is maybe $2,000 a month, right? So cash flow wise is tight, but we're looking at it like we really think appreciation or inflation, depending on how you look at it, we think that price is going to raise considerably over the next 5 to 7 years. So as you think about your single family sweet spot, what do you like?
Yeah. So for me, that 1% rule, I hear that a lot in California. That's where all my single family is. It's not happening. The 1% is not happening. So from that perspective, in California has always been more of an appreciation play. And so for me, it's an appreciation play. And then I'll use that equity on a home to buy other homes. And that's what I've done. That's what my family and I have done. We have about 18 single family properties in California. And that's the name of our game. A little bit of cash flow, but a lot of appreciation because, yeah, in California, when you got your medium price of a home, 380, 400,000, you're not going to rent those puppies for, you're not going to get 1%, unfortunately. So I hope that helps a little bit.
No, I agree. I think the rest of the world's going to have to look that direction as prices go up and rents continue to kind of stagnate, right? At some point, rents are going to catch up across the country, but prices are going to continue to outrun them, I think.
It's funny. You say that about rents. In my place, my rents actually went up more than my appreciation of the home.
Really?
Really? Yeah, it depends on the area. I'll say this, and I think that's why I love real estate. You can look at it from a national perspective, but it really matters on the local markets and where you're at. In Sacramento, the play was flock away from San Francisco, which is 2 hours away, and go into Sacramento, right? It's a little bit more conservative. And when it comes to, the laws and regulations, people like that, especially when it comes to owning real estate, because San Francisco's a nightmare. I'm not even going to get into that. And so from that perspective, that's what was kind of drawing business to Sacramento. And, I represent a few buyers on investment properties. And I'll tell you right now, the inventory is so tight. We put in an offer $100K over asking cash and we got bid out. It went $150K over.
That's crazy.
Just straight cash. It was like $900,000 home, over $1 million. No problem. So you're still working out those bugs in the market. And I think that is kind of a scary thought right now, right? Where people can't find homes really easily. They're losing faith. They're losing confidence. They're pretty pissed off because if you're a first-time home buyer, good luck getting a home.
Yeah.
That's really hard.
Yeah, it's especially if you're getting like an FHA loan or even VA loans have been very, very difficult for people. It's interesting. We're talking about like investing for cash flow versus appreciation. I wanted to note that the biggest, or at least I think they're the biggest, that you probably can confirm, but Invitation Homes, they're a REIT, right? They're a cash flow business. Yeah. According to the business model, you think REIT, they have to distribute 90% of their cash flows.
Nope.
and they're in California. Like their foothold is California. So like, I don't know if you know anything that I don't, but I look at that and I'm like, why?
Yeah, I love Invitation Homes. I talked about them a lot from just a REIT perspective, but you're right. It's not a cash flow play. It's, if you look at their dividend, let me pull it up. What is their dividend? It's like, is it 1%? Is it even that? Oh,
It's not just California. We're pretty heavy in Texas and Florida, and Invitation Homes definitely isn't in the rental markets. I mean, some are in the rental markets, but they're in the nicest places in Austin and Sarasota and Tampa, you know?
I really think it's this institutional flock to single family because they really think builders are going to be really slow. Because builders at the end of the day don't care about people getting in the homes. They don't care about everyone having a home. They care about being profitable. And the problem is if you flood the market with all these new homes and supply, they got burned in 08. They even got burned in 2018. There was a little scare there. They're not going to do the same thing. So I think that's why you're seeing these REITs really focus on the appreciation because they're really betting on that shortage.
Well, I also contemplate, and this is good for anyone listening that's in the single family space, which is probably most people. This is all good stuff, right? Keep buying, get asset heavy, right?
I really think so.
So anyway, but what I think is like, this is to me maybe a flurry at the bell, a boxing term, right? Interest rates are still low. There's starting to become pressure to raise them. Jamie Dimon came out yesterday and said, I don't believe the Fed. I think this is not transitory. Jamie Dimon literally just contradicted the Fed on the front page news yesterday. And like they can borrow cheaply, and multifamily, self-storage, they all have one thing in common, right? There's not 20 million of them, right? Single family homes just has so much supply. There's just so much of it. So Wall Street's like, you know what? We got cheap money, you know, before this casino closes, let's get some assets. And when inflation hits, we have the hedge. That's kind of what I think might be happening.
I think that's absolutely right. I was reading a report that like BlackRock bought billions in the first quarter of single family. So to me, I always tell people, and I know realtors they always say, oh, now's the best time to buy. But honestly, if you're waiting for home prices to fall before you buy your first one, I think you're going to be waiting a long time. And if you can afford it now, and you're not stretching yourself and you can actually afford it, don't try and time the market and wait for that market to correct. But because I really think you're not going to see prices really soften too much until, I mean, probably, like you said, once rates come up. And I don't think the Fed's going anywhere with the rates. I really think they're going to keep it till end of 22, maybe 23.
I tend to think the same. I think the time is now to invest in single family. I think I'm more of an optimist maybe than Frank is. I tend to think we're going up for a while.
Yeah, Frank, I'm curious that, you know, and it's good, right? A couple of bulls and a bear. What's your take on it? Why are you a little bit skeptical?
I don't think I am that skeptical.
Oh, okay.
I think I still think I'm bullish, but I look at behavior of not only your average retail investor, but also institutional money. Like what, and I'm like, the behavior and the psychology of the American investor right now is so out of whack. I'm like, I don't think we can make it 2 years without raising rates. Like there's somewhat of a flock to risk, in my opinion, that's going on. And I'm like, you know what? We need rates to increase. So when the Fed says, oh, we'll wait till 22, 23, maybe we make it to 22. I believe that. But do we make it to 2023? I don't think so. So I think eventually the casino slows down. Yeah. And I think that will have somewhat of a downward impact on single family prices. But I don't think we're going backwards. Like I don't see the 08. Anyone who gets a loan right now, traditionally, goes through the underwriting process. Like I've done a few, right? It doesn't feel out of whack. I'm like, hey, every bank I've been to, they dot their I's, they cross their T's. Every buyer that has bought a flip from us, same thing. So I'm like, you know what? I feel like the process is working. I don't think we're going to have the underwriting risk that we did, but I do think eventually rates will go up in the next year and a half.
Yeah, you know, it's really interesting because single family is one of those weird asset classes where, you know, you can say it's an investment for a lot, but for a lot of people, it's not an investment, right? For them, they only really care about the monthly payment and if it's affordable. Mm-hmm. So I'm kind of curious to see how that plays a toll in single family because, you know, from your and I's perspective, we look at it as an investment, obviously, but for a lot of home buyers, it's not an investment. It's just a place to live, and if they can afford it.
Yep.
Nice. So what about that 60% you put in equities? How do you allocate that? How do you think about allocating that?
Yeah, so it's kind of changed over time as I've gotten a little bit more mature, honestly. So of that 60%, I would say 60% of that is just pure broad-based ETFs, index funds, because I've been in the markets a long time. I don't think you're going to outperform the market in the long run. It never really happens. 95% of investors underperform. It just happens. And then when you get into individual stock picking, it's like 93% of stocks don't even beat the T-bill rate, the real T-bill rate over the long, over what is it, like a 20-year time horizon. So stock picking is really, really opportunistic. So I really try and keep that to a minimum in my portfolio, because I also think real estate's a better opportunity to make more money. I really, from an active management perspective. So that other 40% is individual stocks. And that's where I go into the bets that I'm really comfortable with. So like for me, it was Etsy. I took a 6-figure position in Etsy back when COVID hit. And it obviously was up 250, 300%. Because I had a feeling Etsy was going to crush it. It was kind of a niche business, but the mass sales kind of allowed this management to steamroll their growth. And now it's a pretty big name where Etsy's not just kind of this one-off company anymore. It's a monster right now.
Next question. Would you like to be on our buyers list? No, I'm just playing.
I absolutely would, actually. Yeah. Because it's funny you say that, because I'm always, I got, like you guys said, I got so much stuff going on, but part of my job is managing the family's real estate portfolio and looking for new opportunities, whether that's distressed or what have you. So no, absolutely. I want to be on that buyers list. Yeah, I'm trying to get my family, because they're only California real estate investors, and I'm big into diversification. And I think it's a missed opportunity not to be invested in the Midwest or the South. I'd always like to get my foot in the door there.
Love it. Love it. I love Etsy. My twin brother always tells me I should have bought Etsy. He reminds me of that constantly. But I feel like we have to talk about cryptocurrency if we're talking about all the different asset classes that are floating around in 2021. What's your opinion? Do you have a winner in mind? Yeah. Someone I think maybe someone has to win eventually. I don't know. What's your opinion on crypto? What do you think's going on?
So there's a couple of things there. I think what we've seen recently is a lot of the value of crypto is just tied to the social perspective and the social value we place on it, whether or not we want to believe that. The tweets are what's driving a lot of the crypto volatility. Elon Musk, I mean, we can laugh and say that's not true, but Bitcoin volatility would say otherwise. But for someone who wants to get into crypto, I was trying to stay away from it for as long as I could, but I can see some of the practical applications to it. I think from that perspective, I also tune that into my equity allocation. I think there's ways to get invested in cryptocurrency in the stock market, like banks, financial institutions, credit card companies, things like that. But nonetheless, cryptocurrency, I recently bought like a 3% allocation to Ethereum. And I've heard a lot of things about Bitcoin and Ethereum. And I'm a believer of, it's not about how good you are, it's about getting there first, right? The people that get there first are the ones that have the biggest name, biggest reputation. And I think they stand the best chance. So Ethereum and Bitcoin, I think from that perspective, that's where I would place that money. I would stay the hell away from shit coins, all those Dogecoin, Asscoin, Cumcoin, whatever they're all called now. I would stay away.
Interesting. I would like to go on the record to say I had some FOMO a couple months ago, so I decided to start deep diving into crypto, and ultimately, like, just came to the realization that I think one of the coins are going to win. Which coin is actually going to win? Who knows? And most of them, I think, are way, way overhyped at this point, anyways. Right? Yeah. What do you think about, since we're on this diatribe, if you will, what do you think about it's NTFs, right? Isn't it?
Oh, NFTs,
sorry.
boomer.
Yeah.
Boomer. Oh my God. So I'm not super well versed in NFTs. I'll be honest with you. So I can't speak too much on NFTs. I've heard about them. I know it's what, like digital art or like a digital asset. Is that what it is?
Mhm.
And I heard like what, baseball cards and things like that going for $1 million and things like that. So I don't know. Could you educate me on what your thoughts on NFTs are?
Yeah, I mean, as low of an opinion as I have on Bitcoin, it's even lower for NFTs.
Yep.
So
Good.
I probably shouldn't go that way. How about we shift gears a little bit? And I'd like to tell you, Josh, I think for a 26-year-old, you're wise beyond your years. And
Oh,
the reason
shit.
I'm saying that is we talk to a lot of people, and so many people are talking to us about crypto, and it's clear they're gambling, but they don't realize they're gambling. Right. So my question to you is, where do you get your foundation of knowledge? Who inspires you? How do you, like, you seem very grounded, right? Like, how are you
Yeah.
so grounded in your approach to investing?
Yeah, I appreciate that. And I get that a lot, right? Because my age, someone would automatically assume I have 100% allocation of cryptocurrency and AMC. Clearly, I don't. I think first, it is solely watching my parents being well positioned. So, they weren't doing a whole lot pre '08, but they started building their cash position. And once '08 hit, they just continue to buy real estate. And I know that's not like that instant gratification, but fast forward 15 years or, 13 years now, their wealth has skyrocketed to a point where I'm like, wow, these are really easy things to replicate. So for me as an investor, I want things that I know have a long-term vision and I know that they work in the long run. Cryptos have not been around long enough for me to be confident in. And I study a lot about behavioral finance. And what I see in the Bitcoin space, I think is a lot of sheepness going on and a lot of groupthink theory. So I try and stay away as much as I can from that. And again, it's really hard not to have FOMO, right? Because when I'm spending my due diligence, looking at real estate deals, looking at stocks, and I see these little 16-year-olds get 2,000-3,000% returns on cryptos, it's really hard. But I know over the long run, hot money flows away really, really quickly. And so I'm just going to continue with my strategy. Yeah.
Very nice. I like it. I want to hear more about your 18 rental properties, right? Like, what does that look like? Are you guys keeping equity? Are you pulling equity out and trying to use some burst strategy? What does that look like for you?
Yeah, so they're all 18 single family. And really what those are, they're just cash flowing monsters. They're all paid off. And so our strategy, and it's probably not the best one, they really, because part of it was to fund their retirement and fund other business ventures. So they didn't want to go into retirement with those mortgages. So they did like the debt snowball, if you will. We were focusing the rental income towards one mortgage, paying it off super fast and going to the next one, continue. Now we're gotten to a place where we have pretty much 100% equity in all those homes. Now that's where I'm trying to shift the strategy into other investment opportunities, like more distressed, short term. But that's kind of what it looks like now. I will tell you, so it's all single family. Last year, it wasn't all single family. We had a multifamily apartment complex, a 4-unit in San Francisco. And in 2019, I told them, I told my family, hey, we got to get rid of it. We got to 1031 it in the single family because I started to get bullish late 2019 in single family. And that was right before COVID hit. So we put that property right when COVID hit on the market, and we got top dollar for that San Francisco multifamily. Thank God. San Francisco's tenant laws are crap. Don't ever invest there. And anyways, we took that money, we 1031, and we found opportunities with the new builders. What we found during COVID, when COVID hit in April and May, these builders were sitting on these large construction loans and they were freaking out. They had quite a bit of inventory relative to the demand was not there, right? Because people didn't know what was going on with COVID. Everyone was staying home. No one was buying a home in California. And so typically, if you try and buy a new home from builders, if you try and buy investment properties, they'll tell you to kick rocks. They'll tell you to go screw off. They don't like selling to investors. they were able to take our money and we 1031 that property into 7 single family new builds. And I live in one of them. And in that last year, not only are we cash flowing on those, but also we've gotten about $110,000 of equity in each one over the last year, because single family in California has been nuts. So we have that equity where now I'm trying to develop additional strategy, maybe cash flow strategies. And that's why I'm trying to get into like the Midwest or the southern markets for the cash flow play.
So let me ask one more question. I know I'm like 4 in a row, and then I'll give you the mic, Frank, I promise. Okay, so if you got 18 houses, let's say each of them are 300K on average. My math tells me that's about 5.5 million. If you were to refinance and pull equity out, you could potentially, cut your cash flow down, but then you could potentially pull $4 million out. And earlier in the podcast, you said you could probably get money cheaper than inflation right now, right? So why aren't you doing that? Or why aren't you, campaigning to your parents of like, hey, if we want to maximize IRR here, we need to pull this equity out?
That's a totally good question. So I'll tell you the numbers. So the average home in those is it's roughly about 10 million. And to answer your question, a lot of that so they just got into retirement. So they're trying. So I don't know if you know about retirement. Most people overestimate. They're super conservative about retirement. So believe me, I am working on that. I try and pitch them every freaking day. I tell them, look how much freaking equity we have. But yes, you're totally right. But yeah, there is a level of cash flow that they want. So it's finding that balance. And that's kind of what I'm trying to get on buyers lists. And that is, it's slowly like just knocking on their door saying, hey, mom, hey, dad, let's get, because like the whole San Francisco property, we'd owned it forever. They didn't want to get rid of it. And it took me years to just constantly beat into their head that we needed a 1031 that. So it takes time, but hopefully I'll get there.
Love it. Love it. I implore you again, get on our buyers list. We're going to, or we are hitting Texas and Florida really, really hard. And all your California billionaires are moving there. So you might as well just follow the money.
I might as well, right?
Exactly, right?
But you're not, where are you going to focus though? Are you going to focus in Austin, or is that market too hot?
Our business is more focused on cities that have a high concentration of absentee owners, because those tend to give you homes that do cash flow well, like landlords, right? Like where are all the landlords at? We heavily trade that style of house. Our typical homes, like, 150 grand rents for $1,300. Sometimes we'll also get, the houses worth 60 grand and rents for $850. Like, but what I'm getting at is we play in the cash flow space. Once in a while, we'll pick up a $500,000 house, that's a true flip, that's maybe closer to a California house, but that's kind of just a byproduct of our marketing. That's not what we actually target.
What you target.
Sometimes you get lucky,
Right.
But that's us. I wanted to make sure we covered like what you're really working on every day, which is really like as being an educator, influencer. So tell us about what that looks like right now, and what you're trying to accomplish.
Sure. I think, about 6 months ago when I quit my job, people told me to start a podcast and just talk about, kind of my boomer investment philosophy, if you will. And, because I know that's the one that works, right? Like, people my age, I do pretty well for myself at 26 years old. So I think I can speak to it a little bit more than most people on TikTok that are just pumping. I mean, you would be surprised what's on social media. Like, it blows my mind. It's astounding. So it's just centered around common sense investing for the average individual. So people my age, they're lured into the cryptos and all that stuff, but I want to show another way, a responsible way that over time is less stressful. Because I think the thing that most people don't think about is when you get into those meme stock investing or the crypto space, there's so much stress and pressure there. I couldn't imagine having a volatile asset like that in my portfolio make up 80-90% of my wealth. I couldn't sleep at night. So that's what it's centered around. And it's also centered around just a little bit of comedy as well. And being a little bit more authentic. Because with a lot of people that are investing. They have good information, but they're kind of boring. They're not fun and engaging to speak to. So that's kind of what I'm trying to accomplish there.
So I'll just put half of the real estate educators on blast and say, I think half of them are lying straight up. I think half of them are absolute liars. Almost the other half don't know what they're doing. I think there's a very small percentage that are in fact authentic, are in fact in the game, and are in fact living with kind of high character. So what are some of those, you laid out some of them, what are some of those opportunities that are like, this is what this space needs? How do you fit that space more?
Oh, what does it need? I think it needs people that don't just want to sell a course. And because I think that's what I'm seeing the most right now. I just see people trying to sell their course. And also, I think people need to be authentic of their story. A lot of these people on social media don't talk about the specifics of what they own, how they've come up in the world. And on my social media, on my podcast, I'm pretty open about what I have, what I've done, where I've come from. So I think that's the first, just transparency behind that. Because a lot of people aren't transparent.
Sure.
Yeah, man. Once you become a guru, you no longer experience adversity, right? Like I feel like once someone sells a course, they can no longer be vulnerable, right? It's over.
Right.
So that is the problem. But how are you going to monetize it, right? Like, I mean, maybe you don't need to pay your bills. Like based on what you said, you probably are doing fine. You probably don't need to worry about it. But I'm sure there's some type of monetization that's going to happen. How are you going to do that?
So I'm working on a way, and I've talked about this. It's not instant gratification. People want instant gratification. They want marketing money. They want affiliate marketing. I do a little bit of that. I'll make a couple $100 a month from Instagram. I do that. I have a couple of sponsorships, things like that. But what I really care about is building my pipeline as an investor and in real estate. So I have a real estate brokerage as well. And I've noticed that me just providing sound financial advice, people instantly associate me with anything they might need from an investment perspective. And I feel like that's a good brand to have when I'm building my real estate, wherever that goes. So right now it's building that brand, and then I can funnel the different ideas I have. But direct, I have gotten a few sales from Instagram. I won't lie, a few referrals. So that's how I plan on monetizing it, not directly, if that makes sense.
Like it. And then what are the big opportunities you see for growth there? Like what's currently working to grow your brand? And what do you need to keep grinding out to get it to grow more?
I think it's the consistency. I think you need to consistently post, consistently be out there. Also sticking to your content pillars. So for me, it's like long-term stock investing, real estate and personal finance, and I guess comedy, a little bit of trolling, whatever you want to call it. You stick to those and you'll be fine. But as far as what do I need to do? I think it's just consistently put out content, because my stuff's, my following grows rapidly day in, day out just from that. I will say the other piece that I've found a lot of success on is reaching out to big Instagram, big TikTokers, and telling them to come on the podcast, kind of like what you guys did to me. I've gotten a few, big, couple 100,000 or even million follower accounts on my podcast just from reaching out and say, hey, come on my podcast. And I don't know if it's a testament to, I don't know, my credentials that people see and they're like, oh, okay, maybe I'll give this guy a shot. I don't know, but that certainly has helped too, just the podcast and engaging with other people in the community. I think that's helped a lot.
Yeah. Very nice. How many podcasts have you recorded?
47.
Nice. We're at like 25. So you're about double us. It's my experience podcasting. Number one, I think it's a lot harder than most people think, right?
Yep.
Like most people, or at least I didn't realize how much you had to think on your feet as a podcast host, right?
Yes.
And then also it's interesting, your guest, you would think every guest is kind of equal, but we've had some guests on that you could tell are a little nervous and, they're not as charismatic, and trying to pull that out is a challenge. And then I just think you're absolutely right on just the grind, right? Like the podcast game is very rewarding, but it is a grind, man.
Yeah, and I think for you, you hit the nail on the head. Podcast is a really interesting form, and I like it. That's why, like, I'm not on YouTube really. I mean, I have a channel, but I don't post on it because that's not like, to me, it's not being authentic. A YouTube video, I think you really get to see who knows their shit and who doesn't know their shit on a 45-minute or an hour-long podcast. Because if you can't speak to your stuff for an hour, then you're a fake guru that's just trying to sell a course. Now, with that, also with the podcast, I think and people have different strategies. I don't know what your thought is. I know a lot of people try and map out the podcast episode. They write in-depth notes and all that. I don't like that style. I just like a couple of like phrases, a couple of ideas just to jot my memory. But honestly, it's just all free flowing and, just wing it because it's like an authentic conversation. I don't know. What do you guys think?
I agree. I tend to write down like 6 or 7 bullets, like, hey, these are a couple things I want to cover. And I might write them in the form of a question. But like some of the practice is getting good at follow up. Like no one wants to listen to a podcast where the guest answers a question and then you're like, oh shit, got to get back to my script. Like that's not good flow, right?
No.
But I'll ask you a question. So
Yeah,
you've been doing the podcasting for like 5 or 6 months, I would assume.
Yep.
That's a lot of episodes. That's over 10 a month probably. Recently. Like, how long do you think you have to do this? Or are you willing to do it to get to the 100,000 followers? Like, here's a better question: if someone's just starting, how long should they be expecting to do it before they're successful?
Oh God, I would say, I fully expect my brand to take about 1.5 to 2 years before it starts getting to a point where I'm making a livable income. And for me, I probably need about $35,000-$40,000 to live off of, something like that. I think I could get that in 1.5 years. But as far as how many episodes, God, that just depends. And that's why I've kind of really started to go more towards the Instagram and TikTok to draw my loyal followers in, because the conversion to podcasts, it's hard, right? You guys know this. Podcast is a big investment. So you really have to build that branding first before you can even start a podcast, because who's going to listen to some random Joe Schmo talk for an hour, right? So I think that's been kind of my strategy, is other platforms to draw them into my podcast. Episode count, episode wise, well, I'm almost coming to 50. I've heard 50 to 100 is the sweet spot where you tend to see super crazy growth. I have not seen that growth in my podcast yet, unfortunately, but I'm going to keep plugging away at it because it's fun.
Very, very nice. Are you comfortable sharing numbers at all? We just hit 1,000 downloads, which I think I'm really proud of, but at the same time, you don't have to go far to see people who are crushing us,
Yeah. I have, what do I have? Let me look on Anchor, which isn't everything. I have about 5,000. I'd venture to say probably in the 6 to 7 total range, something like that. I've kind of slowed down on my episodes recently, just because I have a lot of other stuff going on. But yeah, steady growth.
So tell us about comedy, right? And the reason I say that is Frank and I are big fans of comedy. When we did our quarterly offsite with our team, we did stand-up routines like in front of each other, right? Like we're going to do an open mic night. We're all about that stuff. How do you make sure it comes through in a podcast or on your TikTok videos? Because it's like, you're on the line of like being hilarious or just being like a complete douchebag, right? Like how can you make it come off as being authentic and not forced? How do you think about it?
And you know what? I think for me, I think comedy is always going to miss on some people. I actually took the approach where I wanted to be so douchey that it has to be funny. Like there's no way this guy's for real, right? This guy is such a douche. And I don't do that all the time on my Instagram, but some of my reels, like my alter ego is Chad, right? Because I got that a lot in college and all that. That's what I played to. And people are positive to that. They think it's funny. They think it's authentic, and they think it's, something that's different. Because because everyone's trying to put out investing information, financial information, you name it. A lot of people are just trying, rinse and repeating. It's all the same. They're all recycling the same material. So how are you going to add a flair on it and stand out? And I think comedy, you have to have that on there, or at least, yeah, you have to have it. I think.
Is there a stand-up in your future?
No, I'm not that funny. It takes me a lot of time to come up with some of these things. I love comedy, but no, I cannot do stand-up.
Excellent.
I was going to ask a question. I want to make sure we don't miss it. So you had a high-paying job. You're doing well, right? You know, I'm sure, 5 years, 10 years down the road, at some point, you're a managing director, playing golf twice a week at a country club and bringing in clients, maybe sabotaging the financial system. That could have been you. I don't know, but
that would have been me.
Potentially, right? Like, why'd you quit and give that up? And now you're hustling your balls off. I shouldn't say that. Now you're hustling really, really hard.
Yeah.
So why?
Why? Yeah, that's a good question. I took a look at it, and yeah, you're right. I could have done 10 years there and done really well for myself. But you guys know this. What's the fun in that? That's what everyone does. That's not hard. It's really easy. I could have just put it on autopilot for 10 years. But I knew I just wanted something different, and I didn't know what that really looked like. And when I first quit my job, I thought it was just going to be full real estate. This whole Wall Street junkie and my online presence was not a thing. I did not even think that was going to be a thing until probably like January. But I just wanted something different, and I didn't want somebody to tell me what to do. And that was worth giving up money just to follow what I thought was going to make me happier. And I knew I could get to the same place, same end goal. Might take a few more years, but I also put myself in a position where I'm not living off beans and rice. I really worked hard and I saved for those years up to it. So it's not something that you just want to do off the cuff. You really have to prepare for it.
Nice. So now that you're 6 months plus down the entrepreneurial path, what would you say to Josh 6 months ago, your past Josh?
Yeah, the money's not gonna start flowing as quickly and as much as your corporate job was, because I'm very confident. I thought I had a 6-month plan where it was gonna, I was gonna be making 6 figures, things like that. Obviously that doesn't happen. It didn't happen, and I'm learning. So you got to play the long game, and I've learned just consistently, just every day, day in, day out, just keep working. And I think if you go long enough, you're gonna hit it. You're gonna break it. You're gonna break.
Excellent. Well, we really appreciate your time on here, Josh. It was a very fun, easy, authentic conversation. I know you already plugged some stuff a little bit, but please take this opportunity to let our listeners know where they can get more of your stuff.
Yeah, absolutely. Well, Frank, John, I appreciate you guys coming on. So you can guys follow me on Instagram, Wall Street Junkie, WALLSTJUNKY. I'm on Twitter. Wall Street Junkie. And if you're looking for an agent in California who has a brokerage, come my way and I'll hook you up. I'm in the Sacramento area, but I can do all across the state. So I look forward to hearing from you guys. And Frank, John, thanks for having me on again.
For sure.
I love it. Go ahead. Sorry.
We both have follow-up jokes. I like it. I want to hear if you could put on your alter ego, Chad, for a second. Can you take us out as Chad? Like, how would Chad answer that question? I want some of this comedy, man.
Oh, no. Oh, I don't know if I could do it, guys. Oh, God.
You got to at least give us a couple lines.
This is tough, bro. You're asking him to improv in his alter ego. This is next level.
Well, here's what I would say. I can't do it because I don't have a White Claw and I don't have my Oakley rainbow shades. But if I did, I would say, thanks for tuning in, guys. Hope you have a good one. Peace.
I like it.
All right. That was a lot of fun. Josh, thanks again for coming on. We'll have you back on in a couple months. Appreciate it, brother.
Yeah, you guys have a good one.